Happy holidays and Merry Christmas, everyone. Thank you for being part of the AG Squared community, and welcome to AG Squared Self-Financial Audit, Episode 1. I'm doing something today that I encourage everyone to do at least once a year, ideally more frequently if possible, and that is to reflect and celebrate what you've accomplished around your finances. I'm AG Squared, and as you know, I love talking about real estate and finances because both are empowering. When you get your finances right, you unlock life goals, whatever they may be for you, such as providing for family and loved ones, traveling, career growth, personal experiences, and more. I'm organizing this into 4 key segments. First, my overall net worth, to show where I'm at today and where I'm growing or shrinking year over year. Second, revenue streams. My big 2 are real estate revenue and my primary career W-2 revenue. Third, expenses, because knowing income alone isn't enough. You need to see where the money goes. I'll show how I track my expenses, surface insights and trends, and find areas to improve or double down on. And fourth, tying it all together with the budget. Then reflecting and updating my budget based on this analysis. If you don't have a budget yet, this will still be incredibly worthwhile. You'll see an example of a budget and how to embed it into your daily life. Also, check the video above where I show how to start a budget if you don't have one. If you do have a budget, even better. Follow along and replicate. Okay, let's start with the first section, the net worth. In the highlighted area on the top left, I've got 3 columns. First is the asset type, the amount in thousands, and the percent of my net worth. Let's go through each row. At the top, we've got the retirement stock portfolio sitting at $338,000, which is roughly 19% of my net worth. Next, we've got my personal brokerage where I hold various stocks. This sits at $398,000 or around 22%. Then is my real estate business portfolio. This is at $831,000, which is 47%. Now, I really like this ratio because 42% in stock and 47% in real estate is a great balance. But in real estate, many people flash big numbers when they talk about their real estate portfolio, but they don't account for the closing costs. My $831,000 reflects projected profits after closing, which are quite substantial. Without those projections, this number would be well over $1 million. Next is my crypto portfolio, sitting at $65,000. I still view crypto as a high risk and very volatile, so I aim to keep it below 5% of my net worth. Next, cash at around $103,000 or 6%. I recently did a couple cash out home refinances, which gave me even more of a cash boost, closer to around $125,000. And lastly, we've got the emergency cash reserves for my real estate business, which is at $25,000 or 1.4%, which brings my total net worth to around $1.7 million. This is about a 25% year over year jump. And I've only recently started tracking this reflection systematically, so I'll watch whether that growth is durable, but I feel very good about it. Tracking this keeps you focused on where to improve, how much risk to take, and how to position yourself across your career and businesses. So I definitely encourage you that if you're not tracking your net worth, that you start doing so. Let's move on to the next segment, revenue streams. First up, real estate. Right now, I've got 5 properties shown here, when in reality, I have 8, including my primary home, plus 2 additional properties with a business partner. For simplicity, I'm not covering the 2 partner properties since revenue is shared. Okay, to start, let's go over the first column. Column A is the total revenue at $182,000 for the year. In the next column, I break down each property's monthly revenue. Column D shows the total repairs at around $7,800. Column E are the total utilities and yard work, which are at around $26,000. Now, I typically charge back the utilities to my renters, so most of this expense is already covered in the revenue number. On to column F, total mortgage. This includes the principal, interest, taxes, and insurance across all the homes. And we're sitting at $124,000 annually for the cost of all those properties. Now, a lot of people on social media make it seem like getting this number is more complicated and difficult to determine, but a property's total mortgage is very straightforward to project when determining if a home is within your budget or if assessing if it's a potential good deal if you're buying it as an investment property. On to column G, unrealized gains. I track this because the reason I got into real estate 8 years ago wasn't to replace my job. It was to build wealth. There's a distinction, folks. Income/cash flow, what you live on monthly, versus wealth, long-term equity you use for retirement, travel, or passing down to future generations. The unrealized gains column is the principal portion of the mortgage paid down by renters. This grows my net worth, and depending on the loan term and interest rate, often contributes more than cash flow. In my case, across these 5 properties, it's around $37,000. In column H is where we have the cash flow. Across all properties, this is about $24,000. Now, that sure won't replace a full-time job, but cash flow plus principal paydown is about $61,000, which does begin to be a solid annual amount. Now, I've self-operated for 8 years, and I'm happy to share the frameworks and systems that help me scale from 0 to 8 properties, as well as share my journey, the ups and downs, and how to manage properties while keeping a full-time job. Now, with that said, I think 99% of people should not strive to own as much property as I do, but I do think everyone should strive to buy their first house by doing house hacking, living in it for at least a year, moving out, and keeping it as a rental property to then buy their own primary residence. House hacking is the #1 mechanism that allowed me to quickly go from 1 home to 4 homes in 4 years. It's where you buy a home that has a separate in-law suite or with extra bedrooms and bathrooms such that you can live in it while renting out other portions of the home. The reason I recommend this is because your primary home is a liability from an investment perspective, but the rental property is an asset that appreciates, builds wealth, and adds income. Fusing both of those concepts together is a win. Let's move to column K, monthly cash flow. We see a wide range here across my properties, ranging from negative $321 to positive $870 per month. The property with negative cash flow was due to it having a 15-year 3% rate on the loan. It had huge monthly equity, as we see in column G, but the cash flow suffered. After the refinance that I just recently did, this cash flow will change to become around $400 to $500 per month after moving from a 15-year to a 30-year 6.2% loan. Yes, that does mean that it reduces my unrealized gains, but that's a trade-off that I'm choosing for more cash flow. Another home currently generates $869 per month in cash flow. This will increase by about an additional $400 per month to a total of $1,300 after a similar refinance from a 15-year at 6.5% to a 30-year at 6.2%. When I originally bought that property, I put 50% down thanks to a 1031 exchange when I sold a different investment property, knowing that I might later pull cash out and increase cash flow. This property is said to be my best performer across the portfolio. Let's move over to my second revenue stream, my employment or W-2 revenue. Taking a look at my December pay stub, we can see that the gross pay for the year was around $220,000 annually, although there are a couple remaining paychecks not included, so it'll be just slightly higher. The total taxable earnings for this, $307,000, with approximately $106,000 in taxes paid, making up around a little over 30% or $1 in $3 going towards taxes. A ridiculous amount, but a point that I won't digress into. That leaves around $133,000 in consistent income. Now, the 401k employer match is about $7,600 for the year, plus my contributions. Now, several years ago, around 4 or 5 years to be exact, I decided to contribute less to my 401k and put more in my own brokerage and real estate business for better liquidity without compromising long-term growth. But here's an important point, folks. If you struggle to save or stay invested, or you routinely tap into your investments, do not do this. Continue contributing as much as you need towards your 401k in order to max out your employer's contributions. I'm likely not maximizing the employer match, which is effectively a 100% return on investment, the best kind. But that's an ROI, return on investment trade-off that I accept because liquidity matters to me at this point in my business and life. You should decide what is the best approach to saving and investing based on your discipline, your goals, and your risk tolerance. So that wraps up the income section. Let's go ahead and start reflecting on the next segment, which is the expenses portion. This is a high-level summary covering 10 years. Yes, folks, I have been tracking every single expense I've done for the last decade. Before we analyze the chart, here's the information that feeds it from my Excel file. We have the following columns: date, item, category, amount, and month and year. That all rolls up into the annual category table and chart you see here. Okay, let's review this closer. In 2025, the total spend I had was $105,000. When we compare this with previous years, we can see it's still increasing year over year, but that is expected due to inflation and my business ventures. However, most importantly, over the last 4 years, we can see that the rate of increase has slowed down. So I feel this remains in good health. Looking a little deeper into each category, we have cars. We can see when I decided to take on a car loan back in 2022. Before that, I drove 2 cars. Originally, I drove a gifted car from my parents, which I was and am to this day incredibly grateful for. Then I bought a new Toyota Corolla that I paid completely in cash for. No car payments for a long time. But I chose to take on a loan to treat myself to an EV truck for comfort, luxury, and to support my real estate business. I originally went with a Ford F-150 Lightning, but due to its lack of technology and its bland design, I made an easy decision to finally upgrade to my Cybertruck, which I absolutely love. The next category, a cell phone. This cost has been covered by my employer for a very long time, so it remains at $0. Clothing and necessities was the highest it's been in recent years, but still within reason. Food and water, once again, high this year at around $15,000. Yes, I love eating out, I love luxurious and fine dining experiences, and I love treating other people to those experiences as well, hence why this amount is high. Next category, gas. I drive an electric vehicle, so gas isn't a factor, and as I show above, I also charge for free at work or at public chargers, so there's no added electricity cost either. Next, housing and utilities. At $66,000, this has been relatively controlled for the last 5 years, with the big jump being around that 2020 to 2022 timeframe. The insurance cost, pretty much constant throughout these years. The other category covers things like vacations, trips, entertainment. This year, at $4,500 is low compared to the early 2020s, so I'm feeling pretty good about this as well. Now, the poker category stems from a bad habit I started having around 2015, as you can see with the high expenses I endured there, but recently practically none. Let's now look at the chart. This is a stacked graph that shows both the year-to-year change across all categories, but also breaks down each year's expense contributions across all categories. In 2025, the largest category is housing and utilities, similar to previous years. And notice the big jumps between 2020, 2021, and 2022 across this stack. This is around the time when I began scaling my real estate business and took on more renovation costs and began purchasing more expensive properties. The cars category became a substantial contributor post-2022, something that I plan to keep an eye on to avoid it growing further. Most other categories like cell phones, food and water, and other are relatively consistent over the years. Okay, let's move to the last segment, reflecting and updating our budget. I built this budget a long time ago. If you want to create this from scratch, check the video above as I walk through it step by step. At the top left, we have my tax bracket. Below it, my salary. And below that, my income per month. To the right, this is the net per paycheck amount that I get, calculated by taking the total income per month and subtracting the retirement per month. So it's truly net income without retirement that I see in my bank account every month. Let's take a look at the pay stub again to confirm if this value is accurate. Looking at the pay stub, the take home is $5,200 each paycheck, which is higher than my current budget estimate. So I need to go back and update the net pay to be $5,200. In order to do so, I could increase the salary cell, but instead I'm going to adjust the tax bracket to 32%. Now, the way I built this file, everything updates automatically. Now I'll scan each individual row and reflect. I'll also revisit my expenses and update these amounts as needed. Right now, I show a monthly profit. To remove that, I'll increase savings per month. I'm increasing it from $1,650 to $2,150 each month and remove any net surplus. So I know where every single dollar is going towards. Something to note. The estimated spending per month is calculated by adding everything except the retirement and savings. So when I changed that savings amount, the estimated spending amount did not change. That's expected. Let's review the top areas of my budget. Rental property funds at 24%. This covers buying more properties, emergency repairs, and maintenance. I keep a $25,000 real estate emergency fund and ensure to contribute to it whenever it dips. Housing, basically roof over my head, 22%. Savings per month, 21%. Retirement, 11%. Food and water, 10%. Car, 13%. These ratios are very reasonable and responsible. You want most of your budget allocated towards going to what matters. Your business or investment, your savings, your housing, your retirement. The car category at $1,300 per month is high. Ideally, the car budget should be lower than the food and water budget because, well, food is essential. And the car is purely a means to go from A to B. But unfortunately, I really didn't want to treat myself and I decided to take on this expense. Let's go back to our budget and expense tracking. The red line you see here is a budgeted expense amount that came from the previous file for me to target each month. Anything above that means I'm eating into my savings that I had projected to save. In 2025, most months were above that red line due to a large increase in real estate renovation costs that I incurred. I mean, just look at these totals. Real estate is substantially higher and food and water is also elevated. Together, that meant I was spending more than I'd like each month and drowning down my savings. I want to update this so it properly positions me to project my expenses in 2026. Because I expect the rental property fund to remain high as I operate and scale the business, I'm going to adjust the plan to decrease the savings per month amount from $2,150 to $1,650 each month. Rental property fund, I'm going to increase to $2,950 for more breathing. Business real estate moves up to around 29% of my budget. We now also see the allowed expense number that has gone up. I'm going to take that new amount and go to the tabular sheet that you see here that feeds the charts to update the hidden sell amounts right before the total column. That's how the red line that is being visualized is determining what value to use for the chart. Once updated, we see the red line automatically rise. This now shows that in 2025, there were still months with much higher real estate and food costs. So for 2026, I'm going to do two things. First, I'm going to spend less on real estate renovations to keep costs under control. And second, I'm going to reduce my food and water spend. And that concludes this episode in my self-finance audit. We covered a lot of material, folks, and I hope it helps you reflect on where you're at today. Do you have this level of visibility? If not, that's okay. Use this video and my other finance content to help you build habits and systems that give you visibility and accountability to help you make informed decisions. Things like controlling expenses and updating your budget so you have more control over your finances to help you accomplish your goals. If you found this video helpful, please give it a like and share it with someone who would benefit from watching it. And subscribe to my channel for more content around homeownership, real estate investing, finances, and DIY do-it-yourself repairs, maintenance, and renovation projects to help save you money. Thanks for watching. I hope that you wrap up 2025 with a bang and that you have an even better 2026.